A single assumption, one tiny, invisible flaw in the global financial system, ended up costing the world more money than the 2008 crisis and the dot-com crash combined. And the most shocking part is that almost everyone saw the danger forming, yet almost no one believed it could actually explode. This is the story of the 2025 to 2027 global crash, the disaster that rewrote the rules of modern finance and exposed just how fragile our economic world truly is. It began in a moment of confidence, inflated by technology, fueled by debt, and driven by a belief that the world had finally outsmarted risk itself. But history has a way of reminding us that even the smartest eras make the most devastating mistakes. To understand how the crisis began, we need to step back into late 2024. The world at the time was buzzing with optimism. Technology was advancing at breakneck speed. AI startups were appearing everywhere. Chip makers were doubling in value every few months. Governments were promising a new era of stability. And ordinary people, exhausted from the chaos of earlier years, were desperate to believe that things were finally under control. Inflation was cooling, though still not perfect. Interest rates remained high, but stable, and behind the scenes, governments were borrowing money at record levels to support their ambitious programs. But no one paid attention, because the headlines were dominated by AI breakthroughs, trillion-dollar valuations, and the promise that the old rules of economics simply didn't apply anymore. People told themselves a comforting lie: if we had survived 2020 and inflation, surely nothing else could shake us. The spark that would eventually burn down the global economy didn't look dangerous at all. In early 2025, governments around the world began issuing something called stability bonds. They were essentially government IOUs promising safe returns. Investors loved them. Pension funds bought billions of dollars worth, banks stuffed their portfolios with them, and financial advisors praised them as risk-free alternatives in an unpredictable world. But here was the hidden danger. To keep selling these bonds, governments needed to borrow more and more money. They were stacking debt on top of debt, relying on the belief that investors would always trust them. It was like adding weight to a bridge already shaking, telling everyone it could never collapse because it had never collapsed before. By mid-2025, the cracks began to show. China's economy began slowing dramatically. Europe slipped quietly into a shallow recession. The United States saw its debt-to-GDP ratio climb to levels previously considered impossible. Yet, despite these warning signs, markets kept rising. Tech stocks continued their explosive climb, pushing valuations higher and higher. Investors didn't care about warnings. They were dreaming about AI breakthroughs, trillion-dollar industries, and a future where technology conquered every problem. This dream was powerful, intoxicating, and blinding. The world was drifting toward danger, but the glow of innovation was so bright, no one noticed the shadows forming behind it. The first real shock came in January 2026. A medium-sized European country quietly announced it could no longer meet its debt payments. On its own, it shouldn't have been catastrophic. It wasn't a major global power. It wasn't even in the top 10 economies. But the moment the news broke, markets reacted violently. Suddenly, investors weren't wondering about just one country. They were asking which major nation might be next. If one government couldn't handle its debt load, how many others were teetering on the edge? Within 2 days, bond yields surged. Banks froze trading. Pension funds scrambled. AI stocks experienced their first real drop in years. It was the first domino. And as it fell, it revealed a long line of hidden weaknesses the world had chosen to ignore. Then came the second blow, this time from the heart of the boom itself. In June 2026, a major AI company, one worshipped by investors and valued in the hundreds of billions, announced that its groundbreaking AGI-level breakthrough had been massively exaggerated. What people thought was near magical intelligence was actually years away. The revelation shattered investor confidence. Tech stocks plunged. Startups lost funding. Billions vanished in just days. But the deeper problem wasn't the stock crash. It was the fact that so many of these tech companies had borrowed enormous sums of money during their rise. When their valuations collapsed, their debts remained. Suddenly, these once invincible companies looked just like the railroad bubbles of the 1800s, the dot-com companies of the 1990s, and the mortgage giants of 2008. Another bubble had burst, and panic began spreading through the global economy. By late 2026, the crisis evolved into something far more terrifying. A global credit freeze. A credit freeze happens when banks are so afraid of losing money that they stop lending entirely. And when lending stops, the world stops. Companies couldn't get loans to pay workers. Real estate deals froze. Governments struggled to refinance their debts. Startups collapsed by the thousands. Fear became the dominant force in every financial market. People who once bragged about their investment portfolios now whispered about moving everything into cash. Central banks cut interest rates. Governments launched trillion-dollar rescue packages. But none of it restored confidence. Because confidence isn't something you can buy. It's a story people believe in. And for the first time in years, investors no longer believed the story of endless growth and unstoppable progress. The breaking point came in March 2027. A major global bank considered one of the safest and most regulated institutions in the world announced catastrophic losses tied to stability bonds and tech loans. It was the modern Lehman Brothers moment. Markets melted instantly. Currencies swung wildly. People lined up at bank branches, desperate to withdraw their savings. Governments around the world confronted a terrifying reality. They had run out of tools. Interest rates were already near zero. Debt levels were already extreme. Public trust in the financial system was evaporating. The global economy had been built on two assumptions: that AI growth would continue indefinitely, and that governments could borrow endlessly without consequences. When both assumptions collapsed, the entire system built upon them came crashing down. By late 2027, the panic finally began to settle, not because the crisis was solved, but because the world had been forced to face reality. The aftermath was sweeping. Major tech companies merged or shut down entirely. Governments introduced strict new limits on borrowing. Banks were forced into unprecedented transparency. Investors shifted their money out of speculative industries and into real assets like energy, infrastructure, and commodities. The age of easy money, which began after the 2008 crisis and intensified during the 2020s, was officially over. But the deeper scars would take much longer to heal. Families who lost retirement savings would remain wary for decades. Investors who once chased every new innovation became permanently cautious. Politicians who ignored debt warnings were suddenly held accountable. The world had been reminded of an old truth. Every financial crisis begins with a story people desperately want to believe. When you zoom out, the 2025 to 2027 crash follows the same pattern as almost every major financial disaster in history. The Dutch tulip mania of the 1600s. The 1929 stock market crash. The dot-com bubble. The 2008 mortgage crisis. Different centuries, different technologies, different players, but the same human emotions behind them. Greed, fear, overconfidence, and the desire to believe in something that feels bigger than reality. What makes this crash so important today is that its lessons are already fading. New markets are forming. New promises of risk-free opportunities are returning. New ideas are being sold as unstoppable revolutions. Human behavior hasn't changed. The names have, the technologies have, but the psychological patterns remain stubbornly identical. And that brings us to the most unsettling truth of all. The same ingredients that caused the 2025 to 2027 crash are quietly starting to reappear in modern markets. Investors are once again chasing hype. Governments are once again borrowing aggressively. New technologies are once again being valued based on dreams rather than profits. People want certainty, and in that desire, they are repeating the very behaviors that once led to disaster. The patterns are resurfacing, and almost no one sees them. The 2025 to 2027 crash wasn't just a financial disaster. It was a brutal reminder that even the smartest societies can be blinded by their own optimism. But the real question, the one economists still whisper about even today, is this: if the world could collapse from a single flawed assumption once, what happens when the next flawed assumption breaks? Because another cycle always comes. Every era has convinced itself that this time is different. Every era has believed it was smarter than the last. And every era has learned the same painful lesson. Markets may evolve, but human behavior never does. The warning signs are already appearing. The question now is whether we will recognize them, or whether history is preparing to repeat itself once again.